Good afternoon to everybody. I'm just going to make a start while some people might still be joining us. Welcome to our latest Hubbis Digital Dialogue series discussion. And we're here today to talk about developments in the private wealth management market in India. Many thanks to our partner today, Synpulse. We've had the opportunity of doing several things with Synpulse over the course of this year, and obviously super grateful. And we appreciate your support with today's webinar. Now, we have several people on the call, all of which, apart from maybe one, I think are joining us from Mumbai, but I'll probably be corrected in a second. The first of which is Shiv Gupta. He's the founder and chief executive officer at Sanctum Wealth. Nitin Singh, who's managing director and CEO at Organised Wealth Management. Prashant Joshi, co-founder and partner, family office advisory at Upwisery. And also Yash Shah, who I want to say is joining us today from Singapore. A city where he's based, a partner with Synpulse. Those are all the questions that we're going to attempt to get through. I'm certainly not going to read them out. I'm also very excited today because this is, if you like, preempting the physical event that we do in Mumbai, which is at the end of August. And certainly many of the topics that we discussed today are going to be very helpful in defining and refining the proposition and agenda for that event. Now, first question, if I may, to Shiv. Shiv, we've known each other for a long time. I've also had the privilege now of traveling to Mumbai for the last 30 years. Not that the traffic has improved, but maybe one day. And it's also been super interesting and a very interesting, engaging part of my career, watching the development of the private wealth management community in India, and obviously the growth in wealth at so many different levels. So Shiv, maybe looking forward, maybe today, could you just explain in simple words that Yash and I would understand, what do you actually do? So who are your clients? What do you do? Why do you do it? And ultimately, how are their expectations of you changing?
Thanks, Michael. First of all, thank you for inviting me for this panel. It's good to be here as always, and good to be with my fellow panelists as well. Speaking of what we actually do, part of the wealth management community in India, running an independent pure play wealth management outfit, which came out of an acquisition of the Royal Bank of Scotland's private banking business in India. We're all here trying to capture this big macroeconomic opportunity that India represents for all of us, which is, of course, a huge tailwind. But I'm sure we'll be talking about tailwinds and headwinds in the course of this conversation, so I'll leave that a little bit for later. As things stand, I run a platform which has 120 people across 6 locations in the country, managing money for high net worth and ultra high net worth individuals, trying to bring them a full suite of products and services in the sense of whatever you think about wealth management, we're trying to address ourselves. Whenever a client thinks about wealth management, whatever it is that they think about, we're trying to address ourselves to those needs. We focus on high net worth and ultra high net worth clients, and we have roughly $2.5 billion in assets under management. In terms of changing client needs, I think it's useful, and I might be stepping on one or two of the later points as I say this, to think about what are the big things that are moving wealth management in India, and then we can perhaps dive deeper into how things are changing in terms of client expectations, which is your specific question. So obviously, India is in a macroeconomic sweet spot, and there seems to be huge convergence on the idea that a lot that has gone on in the last 7 or 8 years has contributed to bringing India to this position. And where we expect elevated economic growth and elevated growth of wealth creation as well in the country. It's also financializing quite quickly, which is another tailwind. And so the product universe is expanding, has been expanding and continues to expand quite dramatically. Regulation is playing a huge role in the way things are happening here. Competition is playing a huge role as well, because we're not the only ones who think India is a great macroeconomic opportunity. And finally, I think also demographics of the clients themselves are changing, right? Today we have, of course, the traditional clients in the traditional demographic, but we also have a lot of younger clients coming in, younger clients, younger decision makers, a more diverse clientele, more professionals, not just entrepreneurs. And also, wealth is getting more democratized, and the traditional concentration in the big cities is giving way to a larger, wider geographical spread. So those are the big things that are going on. In terms of how expectations are changing, taking into account all of these things that I just said, clients are getting more sophisticated increasingly, and therefore the breadth and complexity of the product suite is increasing. And I'm sure all of us here are trying to find ways to see that our platforms can cater to those. We're certainly doing that. So the sophistication levels are also increasing, I think, which goes hand in hand with an expanding product universe. Internationalization is taking place. There's greater need for cross-border solutions for clients. So we're trying to address that. And I think technology is starting to play a part, albeit this is a little bit more nuanced, and we'll talk, I'm sure, a lot more about that. I'm sure my friend Nitin will have a few things to say about that too, in terms of how much of it is actually getting adopted. But I think, the pandemic gave us an opportunity to accelerate adoption, which has traditionally been a challenge. Having said which, once people have got back to work, there's also been the reverse influence where people have also been reminded of the need for in-person interaction. So I think both forces are at play. So that's what makes this a lot more nuanced. So that's how I would think about evolving expectations. A bit of a long answer, but that's what it is.
That was a great answer, and thanks for getting us started. All right, we're going to get your little friend Nitin. Nitin, thanks for joining us today. So a very broad question to you. I can see half of your head sticking out of the screen, so you need to sit up a bit so I can see you. There you go. Yeah, I can see you now. So anything that Shiv forgot to say? So, I mean, my very broad question to you would be, what else is going to shape the industry over the course of the next 10 years?
No, Shiv as usual in his usual style has been extremely erudite and has covered a lot of bases on what we were talking about. But I think, firstly, of course, thank you for calling me little. I think must be hearing that for the first time after many, many years. And I don't think my wife will agree with you. But anyways, so, I agree with Shiv largely to the fact that India is in a sweet spot today, both from a macroeconomic, demographics, the kind of wealth that is being created, the financialization of wealth, and the fact that generally wealth management is no longer so in the past, financial services was all about lending being the holy grail, right? And you made money only if you had a large lending business or if you had a large, right? And lending moved on to asset management. And finally, I think now over the last year or two, it's been the time for wealth management, and people are realizing that this is a business which, even though it might be intensely competitive, where margins, whilst they continue to be under stress, but this is a business where now today people are saying you will finally make money. I think the trends that are going to really shape over the next 10 years is that I think that we've played a rapid adoption in the last few years in terms of really maturing as a market in wealth management and catching on to what's happening globally, right? In the last 3 or 4 years, we've seen a 10-year journey getting completed, and I think we are still not over. So be it in terms of how platforms evolve, be it in terms of how they become more agnostic, be it in terms of the role of external asset managers, etc. Right? Today, this is a business that is meant for deep pockets. You need to have a large platform. You need to build out a multi-purpose capability. You need to have your own, in various cases, your own asset management or lending capability. So typically, it requires a little bit of deep pockets to make money here. But I think this industry is going to evolve. I think it's going to evolve on the back of 3 or 4 things. One is that you will see disruptive products continue to come in, right? You're going to see levels of servicing and convenience increase tremendously. You're going to see space for true play wealth managers, both from an EAM and an MFO perspective. And typically, Michael, the trends that you're seeing evolve in Singapore, in Hong Kong, etc., you're going to see happening here, because the last thing that's happening, and that's a very rapid evolution, which you had mentioned in your list of questions, is the fact that India is going to become much more global, right? So the connectivity with Asia and the Middle East and how that changes. So I think these are the 2 or 3 mega trends that are happening in India. I also believe, talking on from what Shiv said, and he was asking me to talk a little bit about technology, but I believe that our business is still a contact sport and not a call center sport, right? And we've seen a dramatic and rapid shift of people going back to doing things physically, right? I mean, I can count that in my own travel. I travel 3 days a week now because every client wants to meet you only face to face, right? I think interestingly, you're seeing the digital play still play out in terms of mass and mass affluent, but as you become more HNI and ultra HNI, you still cannot replace the RM, right? And you're seeing that trend play out. So I do think technology will play a role tremendously, at least in the short term, in terms of transforming customer experience, in terms of transforming analytics, right? But yes, over the next few years, technology is going to play a very large role in terms of analytics, AI, customer experience, operational efficiency, and then of course the customer, once he's met you, once he's established trust with you, then moving more and more to an omni model. Michael, you're on mute.
Oh my God, I should have learned that mistake over the course of the last 3 years. You're on mute. I should have made the time frame left. Yeah, I'm assuming everybody on this call, apart from Yash, who's very young, will probably all be retired or gone insane in the next 10 years, so it won't matter. So my next question is around, cost and margin. So certainly everywhere at the moment, your cost seems to be going up at exactly the same rate as your margin seems to be coming down. So, I mean, to what extent does that affect your business model and how you calibrate or decide whether or not this business is successful in the long term?
Sorry,
that's
the question is
question for you. Yeah, easy question for you.
Okay. Yeah. No, I think as I was mentioning earlier, saying so there are two, call it a problem, call it a opportunity. One is that most of your cost is towards talent, and the talent war in this market is not slowing down in any form or manner. Secondly, that there is a dearth of good talent coming into this market, and therefore you only got a pool of talent which is not growing at the same rapid growth as the industry is. So that's point number one. Point number two is that you're right on the back of so SEBI's actually so the regulator, as well as changing regulations and market scenarios, leading to two things. One is that, of course, whilst margins may be coming down, and I'll talk about that separately, but also your intensity in terms of regulation is increasing, which means that your regulatory cost of doing business is rising. And therefore, the kind of systems and processes that you need to put in place and your unit economics does change, which essentially, Michael, means two things. One is you need to be a large platform. Second is you need to have size and scale for operational efficiencies to play out. And therefore, it takes a little bit longer to make money in this business, right? Now, historically, you had the chances of transactional revenues, whilst everybody talks about growing assets and growing an annuity book, right? You had an opportunity. You have to have a mixture of transactional and annuity revenues. I think those have also come under stress, and you are seeing a change in terms of business model. But I don't think that any of that is stuff that is rapidly that wasn't expected, right? I mean, I think both Shiv and I can tell you that it's not that we didn't expect that these things would not happen. There is a little bit of a longer time period within this business, but I think if you're able to keep up with 3 or 4 things. One is that you're able to keep up with a multi-platform, multi-product approach to ensure that you're able to capture all aspects of a customer's wallet. B, you're able to have products that are distinctive, disruptive in some cases, right? You are able to make that average margin of 40 or 50 bits. And C, as you build scale, right, you will start achieving those efficiencies. But typically, it'll take a little bit longer than it took previously. Shiv, do you want to add to this? Because, given the stage of your business?
Yeah, absolutely. I agree with all the points that Nitin has made, including one point he made earlier as well, which was that a long runway is probably useful. It's a business model and how you achieve your objectives and your long-term strategy point. But beyond that, I think the point about scale gets underscored. I mean, if your margins are getting squeezed from all sides, which is essentially what's happening, right? The regulatory actions that we've seen are essentially cheapening products, right? That's one of their stated goals. Competitive pressures are also bringing down margins at the top. Compliance costs are going up and talent costs are going up too. So it's all coming together. So obviously scale is one of the things that it's going to lead to the need for a certain scale and what might have been considered baseline scale 2-3 years ago, which by the way is an amorphous concept. It's very context specific, but even if you blended it and came up with some number, you can easily double it, right? And that's probably where we are right now, just in the last 3-4 years. And you could expect that that might remain the direction of travel in thinking about scale. So it underscores the importance of scale. The 2 points I'll add, one is organizations should think about productivity. I think that, if you can get greater efficiencies within your systems, it could be on the front, it could be at the back, and there are tools and tactics that correspond to both, then you're going to give yourself better economics, right? So for example, the amount of technology that you can properly use on the front line can increase the loading that a relationship manager can have. So if a relationship manager can serve a certain set of clients, call it 40, productively and up to a certain degree of quality, a proper use of technology can maybe increase that number by 20, right? And I think, I think that's a huge needle moving sort of number if you think about unit economics in the business. On the back office too, I mean, if you can do more with technology, digitize your journeys, reduce the amount of sheer brute force that's required in human terms, then again, that's another source. So productivity can be thought of front and back as a way to cope with the way things are moving. And finally, since talent, like Nitin said, is one of the biggest cost areas, like you said, is how do you develop and use talent? Because I think there's still considerable scope in the industry for thoughtful sort of use of acquiring and developing talent. And at all ends of the spectrum, by the way, I don't only mean high net worth and ultra high net worth, I mean even sort of affluent, super affluent and below. And unless organizations invest thoughtfully in this, I just think that, they're never going to be able to meet the needs because the rate at which wealth is growing and, demand is growing, I just don't think supply is going to catch up with that anytime soon. So thinking about developing talent, and it's not just about physical training. It is, of course, a little bit about that, but it's also about coaching, mentoring, organizational structures that support the development of people. I think that's another area where people should think about this. So in response to, this question on margins, I mean, these are things I would add to what Nitin has said.
So,
all
Michael,
right, thanks for that.
yeah, I would love to add to what Shiv said, probably, on the cost side and what Nitin said. On the cost side, there are two parts. One is pure play advisory and one is scale and distribution. And if you break the cost, there are front office, mid office, back office. So what they both said is very true on the size of scale and distribution. But the industry that I represent as a multi-client family office is purely advisory driven. So the front office cost is not that much, because, and on top of it, the revenue from the client at a certain AUM level is limited in terms of advisory fees. So as Shiv rightly said, probably on the scale and distribution, technology can help them to go from 40 to 60. But on our pure advisory play, the entire embracing of technology and lower human intervention only happens at the mid and back office side, because our front end at a boutique house remains very limited out there. So I think probably equal role it has to play for an advisory outfit onto the mid and the back office side of it for a boutique firm, which is pure play advisory, because front loading of cost, which is the front office, is not very humongous out here.
Thanks, Prashant. You preempted the fact that I was about to ask you a question anyway. I was going to move the conversation along into a couple of other topics. So Prashant, for you, in India, like everybody else, we seem to love using this term now, family office, but I don't even know what that means. So what is a family office? Why are we now using that term? And what's the significance of that to everybody within Indian private wealth management?
Yeah. So Michael, I think family office is just an evolution to the word, which was wealth, private banking, and so on and so forth, family office, multi-client family office, and eventually single family office. I think with time they have moved on. And so family office on a very larger scale, basically a single family office setup, which is fairly probably more than $100, $150, $200 million minimum on the deployable asset in the market, and have a team of their own to deep dive into the investment world, more on a direct side and limitedly through a managed account side. So that's how usually the word of single family office started, and that's where it is. So just a term to it, probably, but interesting to say that, the concept of family office or independent firms in this space is getting a lot of attraction vis-a-vis our earlier counterparts from the traditional 2000 and early side of banking side, because of several reasons, which I would love to is one, because of the independence and objectivity the family offices and MFOs or independent firms, so on and so forth, have to offer, because they are not tied to any specific financial product or proprietary solutions, which sort of give them a greater flexibility and objectivity in recommending strategies and frameworks for the clients, which clients will sort of appreciate. So this sort of flexibility, whether provided by a private wealth or a family office, any name you give, sort of is cherished by the client outright upfront.
Right, so thanks for that. Now I'm going to come back to everybody in a moment with some more specific questions. Now, Yash, we've mentioned lots of buzzwords that should be very interesting to you. Obviously talked a little bit about digitization and technology. We've talked about scale, efficiency, empowering relationship managers, communicating with clients, etc. So these are sort of very central to what you do. So maybe a quick introduction to what you do, and then keen to get your thoughts on everything that you've heard from the speakers thus far.
Thanks for that, Michael. Again, very, very interesting thoughts which were shared, especially the one around how the margins are being squeezed, right? And what sort of what that implies, and what's the speed at which wealth managers need to act, right? So just before I jump into that, I think there was mentioned by if not wrong, maybe by yourself, Shiv. So Synpulse, we are basically a boutique management / technology consulting advisory firm, focusing primarily on wealth management and on private banking. Swiss-based, 26 years in the business in Asia for the last 13 years. And basically, if you ask us what we do, we take care of everything in terms of go-to-market strategy, target operating models, wealth models, cost profitability analysis, all the way down to providing end-to-end wealth platforms for wealth managers to run their shop on, right? And we personally have been with Synpulse now for just about the last decade, and also specializing in the wealth management and private banking space, right? Very interesting topic, right? So I think for us, it's very clear that the revenues or the funds are going up, right? There's no doubt about that. There's more and more investable assets which are available at hand, right? And these assets are finding a location where they feel safe. One of my friends in Singapore said very recently, like just like say most of the airlines and flights, even for the dollar now, DIFC in Dubai and BKC in Mumbai are sort of the stopover locations before that dollar flows then into the more Asian markets, more towards Southeast Asia or say North Asia, right? So that's a given, but the margins are being squeezed because of a few different factors, I would say, right? I think it was yourself, Prashant, who briefly alluded to the fact, right, that there are two segments, right, and they're more or less growing at the same pace. On the lower side, we have the mass affluent segment, very big numbers, but the investable assets are not that big, right? Somewhere around 50K to 200K, I would say US, approximately in that range. Very simple products, more flow-based products, right? That's all about, there the cost of acquisition is not that high, but the cost of servicing and providing a platform which can scale, that adds to a lot of the cost, right? On the other hand, of course, you have the high net worth and the ultra net worth individuals, right? There, of course, you need to differentiate on the interaction level, right? There is a reason why a client would like to bank with, say, an Organised or say a Sanctum, right? There are different reasons why they would do that. So there, the cost of acquisition is higher, plus also a very, very respectable amount goes into servicing those clients, right? A very recent study, which I wanted to share here, was around the fact that for any wealth manager who is operating between 1 billion to 5 billion US dollars of AUM, right? They should have an operational cost, so including the operational layer and the technology layer, not more than 15 basis points on a year-on-year basis, right? So let's say if I'm a shop which is $2.5 billion in terms of AUM, have about 50 to 100 wealth advisors, right? Only servicing high net worth clients, right? I should not be spending more than 12 to 15 basis points on running that entire end-to-end operations, right? And if there's anything which I'm spending more than that, there's definitely optimizations which can be done on your middle office, on your risk and compliance layer, on your platform layer, on your technology, etc. And there are different ways of doing that.
Right, so thanks for sharing. It was good, yeah. You're a little bit, your connection's a bit rubbish, yeah. So I mostly heard what you said, but it was a little bit hit and miss. So I'm going to put you on hold for a second, and I'm going to come back to Shiv. But thanks for sharing. Right, Shiv, my question is, and this is in, you're sitting in India with a whole bunch of people that you generically compete with. But I mean, does the client care? I mean, does the client compare you to other people? If they do compare you to other people, what are they concerned about? Is it fees, performance, advice? I mean, to what extent do you even have to differentiate yourself? Or is there more than enough love to go around?
So I think there is quite a lot of love to go around, albeit I'm sure we'd like to see more of it in our own specific contexts. But the general point is that wealth management markets, even globally, are structured in a manner that there's room for many players. Even the ones that look the same, there's room for many players. You could be distribution-led, you could be advisory-led, you could be niche, you could be broad-based, but there is room for several players. There is some number beyond which it becomes unprofitable, but that's quite a large number. So that's the first point. Thinking about what clients are looking for and the basis for comparison. I mean, if you look at wealth management studies that talk about what clients look for, when choosing their wealth managers, they usually have a long list of parameters which represent the client's value curve. It includes things like, performance, of course, the breadth of the product proposition, technology and reporting capabilities, service, trustworthiness, brand recognition, and then a whole bunch of other things that fall into that list of needs, which in some way or the other, either systematically or otherwise, clients will use to, choose who they want to deal with. Sometimes it's just testimonials, other people who are dealing with them. But the way we think about it, we at Sanctum, we distill all of these elements into three key parameters. The first is the perception of trustworthiness, because we're ultimately in the trust game, right? And it could be different sort of coefficients of each for different people, but the first definitely is how trustworthy are you as a platform. Trustworthy could be, are you going to do the right thing? Trustworthy, are you reliable? It includes both. The second is the dynamism of the product platform, or the appropriateness of the product platform, certainly to the point that Nitin was making earlier, where you run both annuity type businesses and transactional businesses at the same time, which most large platforms do, and globally also. I think that the breadth and dynamism of the product platform is an extremely important ingredient, and certainly our clients look at that as one of the driving factors of their decision. And the third is about customer experience. Call it service, call it responsiveness, call it making it easy for clients. I think that's the third pillar. So when we are talking to our clients and even positioning what we're doing, these are the three pillars on which we try and position how we do well. A good combination of the three is, I think, what clients are looking at choosing their wealth managers on the basis of. So trust, ideation, and customer experience.
Right, now I'm going to ask very, very specific questions now. Nitin, the first one for you. I mean, you talked a little bit about the fact that the capital market and the investment choices are now deeper, broader than ever before. So, I mean, for a typical client, what goes in the mix? So if I'm coming to you and I'm looking for you to manage my risk, deliver performance? How are you curating a portfolio? So what's in the mix today? And ultimately, how's that changing?
I think it's a great question, Michael. And to some extent, it depends. Sorry, 1 second. Apologies. Yeah. To some extent, it depends upon the client type. But let's take an example of clients who are coming into a lot of liquidity, because those are the bread and butter of our business today, which is that you're seeing more and more entrepreneurs come into large amounts of liquidity, and therefore they want to build out portfolios. Now, typically for these clients, there are basically two things that are interesting. The first one is that for them, the first most important thing is capital safeguard or capital preservation, right? Because they've got this liquidity over a period of time. They're looking for capital preservation, and then they get into a growth mindset over a period of time. Now, given the rapid evolution of the space over the last few years, there are two things that have led to the rapid evolution of the space. One is the government going and removing the tax incentives on fixed income, which has led to, I would say, a revolution in the fixed income market. I mean, and for want of a better word, I would say a revolution in the fixed income market, because you suddenly had this big daddy called mutual funds that was only playing the role of a warehouse, and which was getting most of the flows just because of a tax advantage, which has to now learn to survive on its own. So the fixed income market has completely broken open. You've got roughly about 7 to 8 sub asset classes within each one of these asset classes. So if I look at fixed income and I go to a client, I'm doing everything for him from AAA bonds to tax-free bonds to looking at performing credit, both in terms of direct paper as well as funds, to looking at stressed assets, to looking at distress, to looking at ARCs. So you've got the full gambit, right? From 5% all the way to 20%, right? In terms of IRR and of course risk. When you look at equity today, again, you've got the full gambit. You're running right from public equity and its various myriad opportunities to private equity, and talking about everything from early stage venture cap all the way to late stage to crossover to opportunities to secondary market. So the world has become very diverse. Typically, what we are doing is that we are playing an asset allocation approach, looking at identifying and clearly defining sub-asset classes within those assets, defining exposures to these asset classes, and building out portfolios over a period of time, right? And that's typically how we are viewing new liquidity, similar to what Shiv would do and what most other people would do. I think clients also becoming much more sophisticated. The interesting thing is that clients today are much more sophisticated and evolved. The questions that they ask, what they want to understand has significantly changed in the last 3 or 4 years. So therefore, you as a platform need to be at the cutting edge of both asset class and your views, as well as emerging product trends within that. And having a very clear focus, you use the word, Michael, on risk, which is that how do you ensure that you're delivering risk-adjusted returns and not increasing risk within portfolios? So I hope that answered that question, Michael.
Yeah, that was more than good enough. Right, now, Prashant, a very specific question for you.
So before that, Michael, I just want to add to what Nitin and Shiv said. When you ask them the question on what a client expects, you have to understand first where in India we stand today and why we are uniquely placed, as for the first time in India, we are experiencing few things at a very large scale. And predominantly 3 things are these. One is the traditional ultra HNI businesses, families inter-wealth generation transition happening from the earner to the new generation. Second is in the last 10 years, the new age tech-driven businesses, promoters are monetizing their businesses partially or fully. That is creating a lot of wealth. And third, there's a growing cohort of super salary and ESOP wealthy individuals which qualify for HNI and ultra HNI. So each 3 of these sects will have their different journey, understanding of asset classes, views, expectations, and requirements that will eventually shape up the private wealth industry for next years. To just break down further, a business family who is transitioning have a very different understanding of real estate commercial to a person who has built up a business in 10 years and have sold off, and his expectations and requirements of the asset classes are different. So I think these 3 things, these 3 sects of people is one which will drive the market in the next 10 years. And also one thing which Shiv mentioned initially is very crucial, is about the wealth moving from metros to tier 2 and tier 3. That in next 10 years is definitely a shift. I do not know how little it will move, but it's definitely a shift happening out there.
So actually, Prashant, just adding to that, and it's a very topical topic. So we actually ran a study with a boutique consulting firm in India, where we got them to do ground up market research on two things. One is, where is wealth going to grow over the course of the next 5 years? We didn't do 10 years, we did 5 years. And second is, what is the persona of the wealth that's going to get created? So interestingly, today about 85 to 90% of wealth in India comes through entrepreneurs or through old money that exists. And by new money, I'm classifying new money as either new liquidity happening through startups or professionals or ESOP holders, etc., which is what you're putting. That shift, that basically 7 or 8% of the wealth today is going to become about 20% over the course of the next 5 years, right? The second is that whilst we're talking about tier 2 cities and you're seeing emergence of them, but the top 13 cities in India, 13 or 15 cities, I've forgotten the number, will contribute to about 92% of the addressable market for somebody like Shiv and me, which is, we are talking about HNIs and ultra HNIs who are essentially have about $5 odd million plus of investable surplus, right? So and of course, you're seeing hub and spoke models, etc., develop. But Michael, suffice to say that you're going to see wealth getting created across the country. The top 13, 14 cities will represent about 90-95% today, which was roughly about 6 or 7 odd cities today.
Right, muted myself again. Right, Prashant, I'm going to ask you a specific question, if I may. So we talked a little bit about the non-investment side of the business, yeah, and I'm just interested. So what are the requirements of people when it comes to, transitioning to the next generation? That could be their personal wealth, the business wealth, and also interested to know how the international piece fits into that. So obviously Dubai, Singapore, elsewhere might factor into that conversation increasingly as well. So just keen to get your thoughts on the demands and expectations on the non-investment side of the business.
Yeah, thank you, Mike. So Mike, just to sort of give you a brief at Advisory, probably got into the conversation without giving that brief. So we are basically a financial service house operating into three main verticals. One is investment banking, other is M&A, tax and regulatory, and third is the multi-client family office or private wealth vertical, as you say. And we are a boutique house, pretty small, and mostly we are catering to ultra high net worth individuals or assisting single family offices, and we are very specific in our services. Now, with this background, coming to your question is that how are people? So basically, I think as and when families are getting more and more of wealth, there's a journey which is happening and which is leading to the questions which is beyond wealth and outside Indian market, right? So every business family or any family which is getting more and more global in nature, either of their generations are moving abroad, either they are staying there, studying there, coming back to help to manage their own businesses, or they are choose to stay there, and eventually families are looking for options, how to move out. And that's where the jurisdictions like Dubai and Singapore sort of come into picture to set up their own global family offices outside Indian jurisdiction. So that's one part. Second part is about the comprehensiveness of the beyond investment journey. So of late, families are getting more and more open, more and more accepting towards the concept of estate and succession, right? And they are wanting to have those discussions around to give a holistic view as to how the assets are held. What are the ramifications of doing an investment today? Because post and legal are never afterthoughts, they are pre-thoughts. So they want to integrate all of this into their investment journey today and look at a solution in totality. So that's what they are trying to think. Coming to the question of India, placing being a hub in, rising connectivity with Asia and Middle East, where a lot of family offices are moving. I believe there is I think there can be a foster of financial exchanges. It can facilitate partnerships for the private wealth industry. I'm talking. It can facilitate partnerships, collaborations between these regions. It does open up opportunities for the Indian wealth industry in terms of clients becoming aware of the opportunities outside to diversify their portfolios. And in some areas which are not available to participate in India, but are available outside globally to participate, is one area where the ultra HNIs or family officers are keenly looking at, right? So to give you a few examples, they are very keen and open to look at ESG in Europe. They are very keen to look at agri-tech in Israel. They are very keen to open up and looking at, a blockchain sort of technology from US. So that definitely opens up the scope for the Indian ultra HNI or family office spaces for investment. Coming to the other part, I think a lot of there is for the Indian per se also, because it also gives an opportunity for the Indian markets to showcase and offer the prospects across various sectors, technology, consumer, healthcare, and infra, which we have. Specifically for the wealth management side, we have been in and out of Dubai quite often of times. We have met all the participants in the market. Maybe it is the private bankers from Dubai or houses from India. We have met many family offices, single family offices outside in this jurisdiction. And we realized that, we asked them a very simple question that, what part of your allocation goes to India? And we got the very clear answers out there that, as they went global, it is decreasing, but it's more coming in through the feeder funds outside India. And we asked a very basic question, you being from India, why haven't you looked at directly participating into India through various assets and managers and so on and so forth? And we got a very unique answer out there that, the information is quite limited. So they want to participate in the Indian growth story or want to leverage the India growth story, but they're very unaware of the options. So from the exchange side of it, any firm outfit which has the capability and scope to set up offices out there and cater to the requirements to participate in Indian growth story, I think that is also one area which is an advantage for the exchange to happen.
Yeah, right.
Michael, may I?
Absolutely, yeah. Sorry, I was going to say, Yash, I'm going to come to you later in a minute, just to wrap everything up. Sorry, Shiv, please carry on.
Yeah, I just wanted to make a couple of points to underscore the importance of estate and legacy planning to sort of kind of add and provide a context. I think, look, in most global platforms, it's an integral part of the wealth management offering at various wealth levels. In India too, it is extremely important and getting even more so because I was reading somewhere that, we are undergoing the largest intergenerational wealth transfer in history, right? Some study said it's as much as $10 trillion over the next 10 years. It's clearly a huge amount. Now, the needs that different people have from an estate and legacy planning perspective will differ based on the size of the corpus, the family situation, domicile, beneficiaries, nature of assets, et cetera. But what is clear is that there is growing complexity in this area and there is a genuine need that clients have. And so managers should, if they're not already building capacity, adding to their capabilities on needs that service, on capabilities that service these needs, which will include things like structuring, tax management, cross-border solutions, transmission planning, of course, which is at the core of all of this, family governance, and even going as far as philanthropy. So I think all of the subjects that cover this non-investment side that particularly relate to estate planning and structuring are extremely important. There's a genuine need. The manner in which clients consume this and the manner in which it gets priced, et cetera, differs, but it's certainly an area where wealth managers have been adding capacity, but there's still a lot more room to go. So I just wanted to add that.
Just want to add to, as Shiv rightly said, the context of the intergenerational transfer is that the families who created their own wealth have their own unique context, and the family who is acquiring the wealth might not have the same unique context and value and belief systems and may want to participate in a very different manner going forward into the legacy of the family. So that requires a lot of thought and structuring out there, as Shiv said.
Good. Right, we're going to go to Nitin, if I may. So, Nitin, very specific question for you. I mean, we talked about so many topics now. You're obviously running a business day to day, but obviously looking to grow that platform in the future. So what would you suggest is your biggest priority for the next 2 years?
So I think an elevator pitch answer is sustainable growth, which is that how do I balance two things? One is that we have had very substantial growth over the last 3 years within our business, both within the wealth industry as well as specifically our business. And Shiv talked about juicing more and trying to drive productivity from what you have today. Right. I think that's point number one. Second is that if we have to capture the opportunity that I spoke about earlier about how India is going to grow over the next 5 years, right? Both in terms of the opportunities that we need to invest, and therefore, how do I balance the two? And I think the third one is that, and Michael, you mentioned it right at the beginning, which is costs are going up, margins are coming down, right? We will need to evolve. I think we as wealth managers over the course of the next year or two, this market will evolve in terms of customer expectations, how we earn money, right? I am a believer of the fact that pieces like customers starting to pay fees, right? There being profit share models that should hopefully get more prevalent. I think the time will come in India sooner rather than later. And how do we ensure that as a business, we remain ahead of the curve rather than, fall behind it? I think these are the three things that keep me awake and that I'm really focused on.
Good. Shiv, same question to you. Biggest priority for the next couple of years?
So I'll also give you three priorities. The first is our frontline capacity building. Like we've all said, the need for, it's still a people-driven business, call it digital or physical, super juiced by technology or whatever, it's still a people business. And I think that there is need for improving the quantity and quality and even thoughts around productivity on the front line. So frontline capacity building is most certain priority. And this is not just this year. Most of these priorities typically span 2-3 years because frankly, they're transformational in the way you think about them. The second is thoughtfully deploying technology. I don't want to give buzzwords around things we want to do because ultimately technology, and we've talked a lot, and even in previous conferences, we've said things around the pertinence of this technology point, but ultimately you can only deploy as much technology as your customers are willing to adopt. So you have to be thoughtful around how they're actually consuming your service. You can't force them to do something unless you've created something that makes them think about things differently, which is not the stage at which I think we are in any transformational way just yet. We might get there, but we're not. So thoughtfully deploying technology front and back is the second priority. And the third is, continued product origination, ideation, innovation. There's so much happening in the product space. The universe, as I said earlier, is expanding. EIFs have expanded. There's so much action in private markets. There's going to be a hell of a lot more happening in international markets, as Prashant has also mentioned at some length just now, and Nitin, and I'm sure we all agree. So the product engine needs continued focus and investment. So it's not something new we're doing, but it's something that we need to continue to focus on an ongoing basis. So those would be our three priorities.
Just one additional question before I go to Prashant. Yeah. So, in terms of the evolution of the business, one thing we talked a little bit about was the concept of, when I first came to India, even, we started this business 14 years ago. Obviously, private banking was very embryonic, and we've seen these different segments of wealth develop. Certainly, very recently, we've started using terms like multi-family office. In Singapore and elsewhere, we've seen the development of an independent wealth management model, what might be referred to as an external asset manager. So that's where we've divided the custody with the concept of delivering advice. So, Shiv, to what extent is that now gaining a lot of traction in India?
Michael, I'm not sure what the question though is. Are we talking about the multifamily office segment specifically? Is that
no? He's talking about is EAM going to gain as a concept, the way that it works.
Okay. Well, thank you, Nitin. I think that I think it will. If you just look at the Indian wealth management market at a macro level, who are the clients and who's serving them? I think there's scope for lots of different models to operate. You will certainly need EMs, particularly as you go a little bit further down the wealth segment. But I would argue that even as you go further up the wealth segment, there is room for, as I said earlier, advice-driven and sort of distribution-driven models, both, because that's just the nature of the market. what specifically represents a target market for each of these segments, whichever way you bucket them, is something that people have to think, carefully about, right? So if you look at what Prashant has been saying, how many people might represent a family office that actually wants multi-family offices and those types of service, and how are those services constructed, and what are the economics of those services will be different from a distribution-driven model. So I know this is a general answer, but I'm making this specifically. I think all segments are evolving in their own way and are at different stages of evolution. There's scope for all of them to succeed, but how many people will be able to find the right business model to make it work at the scale that they desire is a question that will resolve itself over time.
And given India's regulatory nuances and also the way that our business is more open as compared to a Singapore, where private banks who have custody have an advantage because you can't sell a number of things, which if you don't do it through them, your EAM and multifamily offices will evolve in a different model to how they've evolved offshore. But yes, I agree with you. There's going to,
I think there are some added nuances here, and these are two opposing thoughts, and I just want to put them out there. I don't mean to be controversial, but even if I am, it'll be fun for everybody. I think, when we come across clients, we come across plenty of clients who want this sort of, non-distribution advisory only, stay above it all kind of approach. I'd love to do that. I'll only pay you a little bit. And it's sometimes troubling because they are ultimately paying some asset manager quite a lot of money. But there are people who want that because they've decided that the placement of incentives is the only driver of good outcomes at the end of the day, right? I'm not quite sure I agree with that. Then on the other hand, we come across a lot of clients who say, look, I want ideation, dude. This is a fast moving market. There's so much going on. I want to be in the path of ideas all the time. So I want you to keep coming up with ideas in public markets, in private markets, across asset classes, like Nitin said, sub-asset, 7 sub-asset classes of fixed income and a whole world of private markets. So there, just think about that, right? So therefore, what an EM can provide will have to be thought of carefully on either one end or the other end. Even what regular platform can provide, because there are regular, when I say regular platform, I don't mean EMs are irregular, but I just mean like bigger, larger platforms. We'll also have to think about carefully how they want to balance these opposing forces and where they want to focus. I just thought I would add that nuance.
Great. Thanks, Shiv. Prashant, same question to you. 2 biggest priorities for the next couple of years?
Yeah. Thanks, Michael. So I think one priority, as Nitin rightly said, is sustainable growth. That's one part of it. Other part is, which I mentioned earlier, being advisory model, going tech heavy or less human intervention in the mid and back office, so as to ensure we incorporate the right tech to sort of make the profitability numbers work around us. Third would be quite different probably to talk about is that probably, when we are approaching multi-client family office or meeting clients from that segment, we are approaching from the investment policy statement, policy vertical. So probably our challenge or our job is basically, or what we are looking forward is to have a strong due diligence team across various asset classes, because in India today, you can do a due diligence on a fund manager in equity, but a due diligence on capabilities on a private asset manager, private equity player, so on and so forth. So we're trying to build those capabilities inside, because typically when a families come to us, they come to us with a understanding that the investment policy statements, and now these are the 8 products to choose from, and there's a limited pool of capital. There's a finite capital. So unlike a large distribution house, which has the products at their arsenal to sort of meet and sort of do ideation a lot, our family offices sort of want that, okay, these are the things available, and understanding there's a finite pool of capital, prioritize them, right? So that's something which probably is a challenge. We need to we are working on through it and trying to build up a robust due diligence mechanisms across all asset classes. And trying to understand, one more nuance is that a lot of these assets or investments, have been picked as it is basis from the outside Indian markets, and they have been tweaked slightly to suit Indian markets. We have to see the relevance, whether they will eventually sustain their philosophy from outside India, tweaked into India, and will hold the value with their clients. So I think sustainable growth, deployment of technology and mid and back level, and definitely going deep into analytics and due diligence across various asset classes is what our 3 priorities are.
All right, Yash, back to you, if I may. We need to wrap all this up in the next 5 minutes. So Yash, any thoughts on what you just heard from the other speakers and again, how that resonates with you?
I think 3 priorities, and again, I'll just follow suit right here and say, right, I think one which is extremely important, I think most of the wealth managers, not just in India, but across all of our clients regionally are also focusing on is the predictability of that front layer, right? What's the ratio of number of clients? What's the ratio of assets being managed versus a relationship manager, right? I think a lot of investment is going on there. There is, and I would go probably a bit further and also say, right, there's a lot of money being invested in these end client channels, but based on the return on investments we have seen, there's a lot more. There's a multiplying factor. There's a lot more return on investment is generated on technologically enabling your front office rather than your end clients, right? So if you have to spend that dollar on technology, prioritize your relationship managers, your client advisors first, and then go towards your end client, because they might not even want to use that mobile application which you're offering them to do robo advisory, or the fancy stuff. Second, more and more funds being moved towards the private markets, and that's where we see most of the banks also in Singapore, Hong Kong, in Philippines, Indonesia, and also in India. Much more margins are being made, and it's somehow we're finding that client advisors are seeing that it's easier to route funds to those private markets. So I see a larger traction on that. And finally, working on the cost, right? The revenues are going to go up, but the cost, the more you scale, it's going to go up as well. So try to work on the middle and back office layer, try to optimize it. And for us, the golden rule which we use always is 15 basis points. Yeah, don't spend more than 15 basis points.
Right, thanks for that. Now, just one more question, if I may, just to you, just reflecting on one thing that Yash said. I mean, private markets is a conversation that seems to resonate with everybody. But I mean, my question to you would be, if everybody focuses on private markets, what can you possibly do to differentiate yourself from everybody else? I mean, is that a trend in India?
I think, look, there is I break this up into 2 things. One is that private markets is an extremely important asset class or a part of the economy, right? Listed markets don't have all of the economic opportunity that India specifically, or even elsewhere, promises over the next 10, 15 years. So I think you absolutely need to have a capability in that area for most client segments. Albeit I would argue that this corresponds a little bit more to the high net worth and ultra high net worth. And even your private markets exposures can be expressed through collective investment vehicles, or they can be done directly. And the more you go towards direct, then you have to go, further up the spectrum of wealth, right? The wealth segments. So I do think in some way or the other, depending on which segment you're looking at, this is an extremely important asset class, and it's going to remain so for quite a long time. So far as it being a source of differentiation is concerned, I think, look, most wealth managers, and this goes back to your question on what differentiates you or what do you focus on when thinking about how clients will see you differently, is that this is one component of the set of capabilities that in combination should distinguish you for the client, right? And I think it's an extremely important component. I find it difficult to and some will be better at it and some will be less so. And that will then determine which types of clients will deal with them. So certainly, for example, in the direct private market space, some platforms, and I mean, I would even go ahead and say, for example, Nitin's platform, would, just given the way their organization is structured, would have a bigger capability than some other platforms, right? And so those levels of differentiation can exist in that sense. But beyond that, if you're a full-scale wealth manager or dealing with a client who has a private market need, I think it's going to form one component of the basket of needs that, when they are put together, represent what the client wants from you. So that's how I would think about differentiation in this context.
Right, now I'm just going to wrap it up there because we're on time. Now, some of you might have joined because you'd like to get a contribution towards your continuing professional education. Clearly not in India because you don't need any continuing professional education. However, many people do. So we don't just send you a certificate of attendance. You've got to fill in my little survey and quick survey and questionnaire that I send over, but it's super difficult in so much as I now give you the answers. So you need 3 numbers from me to fill in the questionnaire. You need the number 1, you also need the number 26, and you also need the number 180. Also 3 questions. Nitin said several incisive things on this call, but for the sake of the question, he said that his number 1 priority is sustainable growth. Shiv said several things. He said his number 1 priority was frontline capacity building. And Yash said that there's much more emphasis across the region today on private markets. So thanks to everybody. Super grateful for your time and participation. Looking forward to seeing most of you, hopefully, at the end of August in Mumbai for our physical event. And again, hope you all have a nice afternoon / evening ahead. Thank you very much.
Thank you, Michael. Thank you, everybody.
Thank
so much.
you. Bye-bye. Take care.
Thank you, everybody.
Bye-bye.
Bye-bye.